This video is about the theory of the firm in terms of their revenue and profit. So in the first year we looked at revenue and profit, and we did that using this table to show how the different types of revenue are calculated and how those are likely to change across different ranges of output. What we're going to be doing now is thinking about how we could show some of those things using revenue curves. So those revenue curves are showing us how revenue changes across different levels of output on a diagram. And so looking at the average revenue curve first, average revenue, remember then, is total revenue divided by quantity. And so that curve is going to be a downward sloping curve, which looks like this here, and it is going to be equivalent to the demand curve. And the reason for that is because if you think about what average revenue is, total revenue divided by quantity of output, essentially it is the selling price at each of those ranges of output. That is what average revenue is. And if you put that onto a diagram, think about what the demand curve shows. It shows the quantity that is demanded at each of those different selling prices on the diagram. And so your average revenue is the selling price at each level of output, or the average revenue at each of those levels of output. So the average revenue curve and the demand curve will be one and the same. Moving on now to the marginal revenue, which is the extra revenue from selling one additional unit of output. So that is going to be calculated by the change in total revenue divided by the change in output. And the marginal revenue curve will start at the same point on the y-axis as the average revenue curve, but it will fall with twice the slope, so it will be steeper than the average revenue curve. Now the reason for that is because in order to sell that additional unit, you now need to sell all units at this price, not just that marginal unit. So going back to the table, you could say that you could have sold 2,000 units at £180 each, but if you want to sell 3,000 units, then you need to sell all of your units now at £160 each, not just that 3,000th unit. So this means that while the average revenue here at 3,000 units will be £160, the marginal revenue, that extra revenue from selling the additional unit, will be £120. And then finally, in terms of the revenue curves, you have total revenue, which is equal to price times quantity sold. And the curve in this case will be an upside down U shape. Now the reason for that is because when quantity demanded, quantity sold is equal to 0, it doesn't matter what the price is. If you're not selling anything, then total revenue is going to be equal to 0. So it starts there at 0. And when price is equal to 0, again, doesn't matter how much you sell, if the price is equal to 0, then total revenue in that case will be 0 as well. And then starting from that initial point at the origin of that axis when it's 0, as the price falls along your demand curve and the quantity demanded increases, that means that the total revenue is going to be rising up to a point, and then you find that the price gets so low that the additional quantity that the price drop brings in, it starts to get dominated by the fall in revenue from reducing that price further, and then at that point the total revenue is going to start to fall back to the point where it goes down to 0 again. And you can see on the average revenue curve, I've labelled on the elasticities on there as well. So along the straight line demand curve, we'll find differing levels of price elasticity of demand. And the reason for that, how we know that, is because if total revenue is rising when this price is falling, we know that the demand in that situation must be price elastic from our knowledge and what we know about price elasticities of demand. And when price elasticity of demand is unitary, we know that total revenue is maximized at that point. And when price elasticity of demand is inelastic, it must be the case when price is falling, that total revenue is falling as well. So we can kind of infer those elasticities from what's happening with this total revenue curve. And one final thing to say about that is that it's no coincidence here on the diagram that the total revenue is maximized at the point where that marginal revenue is equal to 0. Because if the marginal revenue is positive, as it is across this range of quantity of output, then total revenue must be increasing with the addition of a further unit of output by definition of what marginal revenue is. Whereas if the marginal revenue is negative, so as it goes beyond this quantity axis, you could carry that curve on, making it negative, then the total revenue must be falling as we add additional units of output by definition, again, of what marginal revenue is. If that marginal revenue is negative, that means that adding an additional unit of output is going to reduce the revenue, and so total revenue will be decreasing in that situation. So moving from revenue now onto profit, which is calculated in its most basic form by total revenue minus total cost. Okay, so in terms of the table, you've got 1,000 units of output, you're making £200,000 revenue, your total cost is £270,000, total revenue minus total cost gives you your profit, or in that case loss, of minus £70,000. So that's the really most basic calculation of profit that we'd use across all business and economics really. But the key thing in economics specifically is that we calculate profit slightly differently to how you would in accounting and how actually most normal people would think about profit, because we include opportunity costs in our calculation of total costs. And I think the easiest way to think about that is using an example. So imagine that you work for a florist and you're earning £25,000 a year in that job. But then you decide to leave and start your own floristry business, and after all your costs, your accountant tells you you've made a nice profit of £30,000 in your first year, which you're quite happy with. But the economists would say that actually we need to include that £25,000 opportunity cost that you could have earned in your other job, which you've given up in order to start your own business. So actually in that case, your economic profit would actually be £5,000, not £30,000. And so we call it normal profit when a firm earns just enough revenue to cover their total costs. And so in accounting terms, we would talk about that as being break even, but actually we're including those opportunity costs that accountants wouldn't. So we call that normal profit. So that's what we need to earn really to keep us in business long term. Otherwise, it would be more rational for us to go back to our other job working for the florist if we were going to be earning less than £25,000 a year. Now, supernormal profits are any profits made over and above those normal profits. So that's sometimes called abnormal or economic profit. So in that first example that we had, you've got your profit of £30,000, but then your opportunity cost of £25,000 that we said we needed to take into consideration as well. So your supernormal profits or abnormal profits or economic profits, I think was the term that I used in the first place, would be £5,000. So profit is really crucial to the functioning of a market economy because it acts as an incentive, and particularly to suppliers. When demand increases in a market economy and price rises, firms increase their supply, and it leads to an extension along that supply curve because they're hunting for those higher profits. It also provides a reward for enterprise, and it encourages innovation and risk taking. So without the incentive of profit, you wouldn't have entrepreneurs taking risks, asking for loans and trying to grow their business, which is a really, really important part of our economic systems. It also acts as a signal to new market entrants. So markets with high supernormal profits are generally going to be ones which attract a number of new entrants. It's signalling those new entrants to move into that market because of those supernormal profits, and they get attracted by them. And it also means that when firms are taking decisions on which out of a range of different products to make, then it can help to indicate to them which goods and services they should be providing based on where the highest profits are.